There's a technical term banks use for customers who pay their credit card bills on time every month. They call them deadbeats. Not joking. Walk into any credit card company headquarters, sit in on their quarterly planning meetings, and you'll hear executives discuss their deadbeat problem. The problem being you, the person with money saved, the person who pays bills on time, the person who doesn't overdraft. You're the nightmare customer because you cost them money and generate zero profit. Meanwhile, someone living paycheck to paycheck who overdrafts 3 times a month and carries a $4,000 credit card balance at 27% interest, that's their ideal customer. That person funds the entire operation. Today, I'm breaking down the perverse incentive structure that makes your financial stability a threat to bank profitability. Why $50,000 in savings puts you outside their extraction machine, and how being boring with money is the best revenge against a system designed to profit from desperation. So here's what we're doing. I'm going to walk you through the actual economics of how banks classify customers, the shocking math behind customer profitability tiers, and why every dollar you save is a dollar they can't extract through fees. Then I'll show you the numbers behind what I call the broke tax, how the system is deliberately engineered to extract maximum revenue from financially vulnerable people, and why your escape from that system makes you worthless to them in the best possible way. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of the banking system as a massive extraction funnel. At the top, you've got everyone who uses financial services. As people move down the funnel, the bank extracts money through various mechanisms. Overdraft fees, credit card interest, loan origination fees, late payment penalties, minimum balance charges. The funnel is designed with one goal: capture as much money as possible from each customer as they pass through. Now here's the thing. Some customers drop straight through the funnel without touching the sides. They never overdraft because they have savings. They pay credit cards in full because they have cash flow. They don't need emergency loans because they have buffers. These customers are what banks call unprofitable. And $50,000 in savings basically gives you a jetpack that lets you fly over the entire extraction funnel. Banks spent an average of $561 to acquire you as a customer. They ran ads, they paid referral bonuses, they set up that nice branch with free coffee. And if you're financially stable, they're never getting that money back. Let me tell you about a banking conference that happened in 2007. It was documented in a film called Maxed Out. Credit card executives were asked about their ideal customer profile, and they said it explicitly. They don't want people who pay on time. They want what they call revolvers, people who carry balances month after month. They admitted on camera that customers who pay in full are called deadbeats and freeloaders. The terminology is formal. It's in their internal documents. Transactors are people who pay in full. Revolvers are people who carry balances. And the revenue split is absurd. About 50% of credit card users are transactors. 50% are revolvers. Pretty even split. But when you look at revenue, heavy revolvers who carry balances every single month generate 72% of all credit card interest. Transactors generate 0.7%, not 7%. 0.7%, almost nothing. The entire credit card industry runs on people who can't pay off their balances. And if you have 50,000 saved, you're not carrying a balance. You're a deadbeat. You're using their product and giving them nothing. Now, you might be thinking, okay, but they make money other ways, right? Transaction fees from merchants, annual fees, stuff like that. Sure. But those numbers don't move the needle on customer profitability the way fee extraction does. There was a study of 70,000 bank customers that broke down profitability by segment. 48% of all clients generate zero profit or actually lose money for the bank. Almost half. But here's where it gets really interesting. The top 1.56% of customers generate 50% of all profits. The bank could literally fire 90% of its least profitable customers and still keep 85% of its profits. So who are these magical top-tier customers? They're not millionaires with huge account balances. They're people who overdraft constantly, people who carry credit card balances, people who need high-interest personal loans. The math is brutal. A customer who frequently overdrafts generates over $700 per year in profit for the bank. A customer who never overdrafts generates $57. That's a 12 times difference. For credit cards, the gap is similar. A revolver generates about $240 per year in profit. A transactor generates $25. You, sitting there with $50,000 in savings, paying everything on time, never overdrafting, you're generating maybe $50 a year for them. You might actually be costing them money when you factor in the operational costs of maintaining your account, the FDIC insurance they pay, the customer service interactions. You're a net negative. Let me show you exactly how this plays out with two real customer profiles. Customer A is named Sarah. She makes $65,000 a year, lives paycheck to paycheck, has $800 in checking, nothing in savings. She overdrafts an average of 4 times per year at $35 per overdraft. That's $140 in overdraft fees. She carries a credit card balance of $4,000 at 22% APR. She pays the minimum each month, which means she's paying about $730 per year in interest. She took out a personal loan last year for $3,000 to cover an unexpected car repair at 15% interest. That's another $225 in interest annually. Added up, Sarah generates $1,095 per year in direct fee and interest revenue. Customer B is named Mike. He makes the same $65,000, but he has $50,000 in savings, never overdrafts, pays his credit card in full every month. Didn't need any loans because he has an emergency fund. He generates 0 overdraft fees, 0 credit card interest, 0 loan interest. The bank makes about $30 a year from him through various transaction fees. Mike costs the bank money to maintain. Sarah funds the entire operation. The system isn't designed to help Sarah build wealth. It's designed to extract maximum revenue from her financial instability. Here's the kicker on customer profitability. Banks know exactly who you are before you even walk in. They buy credit data, they analyze spending patterns, they can predict with scary accuracy whether you will be a revolver or a transactor, and their marketing targets the revolvers. American Express spent $6.3 billion on marketing last year. JP Morgan Chase spent $4.9 billion. Capital One spent $4.6 billion. Almost all of that money goes toward credit products, not savings accounts, not investment services, credit cards and loans, because that's where the profit is. Credit cards generate a 6.8% return on assets for banks. That's 4 times the banking industry average. They're not advertising savings accounts because there's no money in you saving. There's only money in you borrowing. Now, let's talk about what I call the broke tax, because this is where the extraction funnel gets really dark. Financially vulnerable households spend 17% of their entire income on financial service fees and interest. Financially healthy households spend 1%. That's a 17 times difference. The poorest 15% of the population pays 27% of all financial service fees. That's over $110 billion per year extracted from people who can least afford it. Think about that structure. The people with the least money pay the highest percentage of their income to banks. Low-income households are 3 times more likely to get hit with overdraft fees. 34% of households earning under $65,000 faced overdraft charges last year. Only 10% of those earning over $175,000 overdrafted. The fee hits hardest where it hurts most. Credit card interest rates show the same pattern. Poor credit scores get rates of 27 to 33%. Excellent credit gets 19 to 21%. Auto loans for subprime borrowers hit 15.85%. Prime borrowers pay 5.18%. On a $30,000 car loan, that difference costs over $5,000 in extra interest. The entire system is designed to extract maximum money from people who are struggling. And the person with $50,000 saved has escaped the extraction machine entirely. There's a McKinsey report from 2024 that accidentally revealed how worried banks are about customer education. The report warned that if AI tools help even 5 to 10% of consumers move their money from low-yield checking accounts to high-yield savings accounts, bank profitability could decline significantly. Read that again. They're worried about you being smart with your money. Your financial education is their financial threat. Because right now, the average savings account pays 0.01% interest. Online high-yield savings accounts pay 4 to 5%. Same FDIC insurance, same safety. But most people don't know that. So their money sits in checking, earning nothing, while the bank lends it out at 20% through credit cards. That spread is pure profit. And if you wake up and move your money, their model breaks. Here's a story about how banks think about customer profitability optimization. I was talking to a former bank executive who worked in the consumer lending division of a major national bank. He told me about their internal customer scoring system. Every customer got assigned a profitability score based on predicted lifetime value. The score wasn't based on account balance. It was based on likelihood to generate fees. They had algorithms that analyzed your transaction history and predicted future overdrafts. If you overdrafted once, the system flagged you as high probability for future overdrafts. And here's what they did with that information. They adjusted your available credit deliberately to increase overdraft likelihood. Let's say you typically spend $2,000 a month on your debit card and maintain a $1,500 balance. The system knows you're cutting it close. So when you have an unusual month with an extra $400 expense, instead of approving the transaction and maybe sending you an alert about low balance, they'd decline it and charge you a $35 insufficient funds fee. Then they'd send you an offer for overdraft protection, which sounds helpful, but it's really just a high interest line of credit that generates more fees. The whole system was optimized to push people into fee-generating behaviors. And the customers who never triggered these flags, the ones with cushion in their accounts, they were marked as low value and basically ignored. This is where it gets cynical. Banks have a term for the revenue they make from fees. They call it non-interest income. And non-interest income has become increasingly critical to bank profitability over the last 20 years. In the 80s and 90s, banks made most of their money from the interest rate spread. They paid you 2% on deposits and lent it out at 7%. That 5-point spread was the profit. But interest rates have been low for years, which compressed that spread. So banks shifted to fee-based revenue. Overdraft fees, ATM fees, monthly maintenance fees, wire transfer fees, insufficient funds fees, foreign transaction fees, paper statement fees, inactivity fees. The fee structure exploded. And it's regressive. The fees hit hardest on people with the least money. There's a reason for this. Someone with $50,000 in savings isn't checking their balance obsessively because they're not living on the edge. They're not going to accidentally overdraft. They're not going to get hit with an inactivity fee because they forgot about an account. They're not using out-of-network ATMs because they planned ahead. All the behavioral traps that generate fees just don't apply. Banks optimize their fee structure to profit from cognitive load and financial stress. And if you're not stressed about money, you don't fall into the traps. The second kicker is about how savings change your negotiating power. When you have $50,000 in the bank, you have options. Real options. Let's say your credit card company raises your interest rate. If you're carrying a balance and living paycheck to paycheck, you just accept it. You need that credit line. You can't afford to close the account. But if you have $50,000 saved, you call them and say, lower my rate or I'm closing the account and paying everything off today. Different conversation entirely. Same thing with bank fees. If they start charging you a monthly maintenance fee and you've got $50,000 saved, you move your money to a different bank. Takes an hour. No big deal. But if you're living on the edge, moving banks is risky. What if there's a delay in transferring your direct deposit? What if a payment doesn't clear in time? You can't risk it, so you stay and pay the fee. Banks know this. They know that financial instability creates customer lock-in, and they exploit it. There's a concept in behavioral economics called present bias. People overweight immediate costs and benefits relative to future costs and benefits. Banks use this against you. They offer you a credit card with an amazing sign-up bonus, $500 cash back if you spend $3,000 in the first 3 months. Sounds great. That's an immediate benefit, but the card has a 24% APR. That's a future cost, and it feels abstract. So you take the card, you get the bonus, and then you carry a balance for the next 5 years, paying thousands in interest. Present bias made you focus on the $500 carrot and ignore the long-term cost. But when you have 50,000 saved, present bias doesn't control you. You can pay off the $3,000 immediately, take the $500 bonus, and never pay a cent of interest. You're using their psychological tricks against them. You're being what they call a credit card hacker, and they hate it. Now you're asking yourself, okay, if banks hate savers, why do they even offer savings accounts? 2 reasons. 1, regulatory requirements. Banks need deposits to meet reserve requirements and maintain their lending ratios. Your savings account deposits are technically a liability for them, but they need those liabilities on the books to justify their lending activities. 2, customer acquisition and potential conversion. They're hoping that even if you start as a saver, eventually life will happen. You'll have an emergency without enough buffer, you'll make a financial mistake, you'll need a loan, and then they've got you. They're playing the long game. They'll accept low profitability from you now in hopes that you'll eventually become a high-fee customer later. But if you maintain that $50,000 cushion and grow it over time, you never convert. You stay unprofitable forever. That's the nightmare scenario for them. Let me paint you a picture of what $50,000 in savings actually means in terms of financial behavior. It means you're not checking your bank balance before buying groceries. It means an unexpected $600 car repair is annoying, not catastrophic. It means you can wait for a sale instead of financing a purchase at 22% interest. It means you can negotiate better rates on everything because you can always walk away. It means you're not using credit cards as emergency funds. It means you sleep better. And all of that psychological peace translates into behaviors that generate zero revenue for banks. You're not making desperate decisions. You're not accepting predatory terms. You're not paying convenience fees because you're not cutting it close on timing. The whole fee extraction model is built on financial stress and poor planning. Savings eliminate both. Here's a quick example of how banks structure products to discourage savings. Most checking accounts pay 0 interest. Some actually charge monthly fees if you don't maintain a minimum balance. The minimum is often $1,500 to $2,000, just enough to be annoying, but not enough to be a real buffer. Meanwhile, they make it slightly difficult to move money from savings to checking. Not impossible, but there's friction. You can only make 6 withdrawals per month from savings without a fee. At least that was the rule before 2020. The whole structure is designed to keep your money in checking where you'll spend it and potentially overdraft, rather than in savings where it would protect you. And the interest rate they pay on savings is laughable. 0.01% is common at big banks. On $10,000, that's $1 per year. Not a typo, $1. Meanwhile, they're lending that $10,000 out through credit cards at 20%. They're making $2,000 a year on your money and paying you $1. The spread is the scam. There's a banking executive quote I think about a lot. It's from a 2008 investor call during the financial crisis. The exec said, "Our most profitable customers are the ones who use our products the most." Sounds reasonable until you think about what it means. Using banking products means borrowing, overdrafting, paying fees, not saving, not being financially stable. Their most profitable customers are the ones in the most financial distress. That's not a bug. That's the model. And $50,000 in savings pulls you out of that model entirely. You become unprofitable by being financially healthy. It's perverse, but it's rational from their perspective. They're optimizing for shareholder returns. And shareholder returns come from fee extraction, not from helping customers build wealth. This is where the system reveals itself. Banking isn't neutral. It's not a simple service provider relationship. It's a carefully designed profit extraction mechanism with incentives that run counter to your financial well-being. The better you do financially, the less money they make. The worse you do financially, the more they profit. And once you see that structure clearly, you can't unsee it. Every product offering, every fee structure, every marketing message is designed with that incentive in mind. They want you borrowing, not saving. They want you stressed, not stable. They want you dependent, not independent. $50,000 in savings is your middle finger to that entire system. So how do you become the customer banks hate? 3 concrete steps. 1, build the buffer. Start with $1,000 emergency fund, then grow to 3 months of expenses, then 6 months, then beyond. Every dollar saved is protection against the fee extraction machine. You want to get to the point where overdrafting is literally impossible because you have so much cushion. 2, pay credit cards in full every single month. Never carry a balance. Use their rewards, take their sign-up bonuses, and give them 0 interest in return. Be a proud deadbeat. Track your spending if you need to, but the cardinal rule is full payment every month. 3, optimize your savings rate. Stop leaving money in checking accounts that pay nothing. Move it to high-yield savings accounts that actually pay you. 4 to 5% is the current rate at online banks. Same FDIC insurance as the big banks. No reason to give them cheap deposits. And as your savings grow past $50,000, start thinking about investment accounts. Because at that point, you're not just escaping the extraction machine. You're building real wealth. The reality of $50,000 saved is this: you're no longer profitable to exploit. Their entire fee structure doesn't apply to you. You have options they can't take away. The average American has less than $1,000 in savings. 78% live paycheck to paycheck. 59% can't cover a $1,000 emergency. Those statistics represent billions in bank profits, overdrafts, interest, fees, penalties. The whole machine runs on financial desperation. 50,000 puts you outside that machine. You're not participating in their profit extraction anymore. You're just a boring customer with a savings account they barely notice. And that's exactly where you want to be. They call you a deadbeat. Wear it with pride. Lazy investing built more fortune than crypto memes. The goal isn't to be loved by your bank. The goal is to be so financially stable they can't make money from you. Go stack that savings. Your bank's quarterly earnings will be slightly worse because of it. And that's a beautiful thing.